trying to decide between real estate and stocks. Today, we're breaking down the pros and cons of each to help you figure out where you should invest your money. Let's dive into the world of investing and see which option could work best for you. Investing in real estate and stocks has long been a popular route for wealth generation, each offering distinct advantages and challenges. Choosing between the two depends on several factors, such as your risk tolerance, time horizon, and financial goals. To make an informed choice, it's essential to understand the unique benefits and potential drawbacks of each asset class. Here's an in-depth look into real estate and stocks to help you decide where your investment dollars might be best spent. 10. Stability and tangibility. Real estate offers tangible physical assets, like homes, buildings, or land, which can give investors a sense of stability. This tangibility can appeal to those who feel more comfortable investing in something physical rather than virtual. Real estate values tend to be less volatile than stocks, often acting as a hedge against inflation and economic downturns. Stocks, on the other hand, represent ownership in a company but lack physical presence. While their prices fluctuate regularly, they allow investors to buy and sell relatively quickly, providing liquidity that real estate often lacks. Stocks can be a wise choice for those comfortable with the fast-paced nature of the financial markets. 9. Potential for passive income. Real estate is a prime source of passive income through rental properties, creating a steady monthly cash flow. Investors can earn from renting out residential or commercial spaces, and as property values increase, their net worth rises as well. For long-term investors seeking regular income, real estate can be ideal. Stocks offer passive income in the form of dividends, where certain companies distribute a portion of profits to shareholders. Dividend stocks can be a great source of regular income, though the payout isn't always guaranteed. Those looking for high-yield income streams may prefer dividend-paying stocks or real estate investment trusts, REITs. 8. Entry costs and barriers. Real estate investments typically require significant capital upfront. Purchasing property involves down payments, closing costs, property taxes, and ongoing maintenance fees, which can be prohibitive for new investors. However, there are creative financing options, such as mortgages, that allow investors to leverage borrowed capital. Stocks are generally more accessible, allowing individuals to start with smaller amounts of money. Fractional shares also enable investors to buy portions of high-value stocks without breaking the bank. For beginners or those with limited funds, stocks offer a straightforward entry into the investment world. 7. Risk levels and market volatility. Real estate is considered relatively low risk because property values tend to appreciate over time. While local market conditions can impact property values, real estate usually doesn't experience the rapid daily fluctuations common in stock markets. This lower volatility appeals to investors looking for a more stable investment. Stocks, conversely, can be volatile, with prices impacted by market trends, economic conditions, and even geopolitical events. While this volatility can lead to high returns, it also brings higher risk, making stocks more suitable for investors with a higher tolerance for fluctuations. 6. Potential for growth and return on investment (ROI). Both real estate and stocks have potential for impressive growth, but in different ways. Real estate values generally increase over time, especially in growing regions with high demand. Leveraging property through mortgages can further amplify returns, increasing investors' overall ROI when the market appreciates. Stocks, however, offer higher historical returns compared to real estate, with the S&P 500 averaging an annual return of around 10% over the long term. Stocks have immense growth potential through capital appreciation and compound interest, making them attractive for investors seeking long-term wealth accumulation. 5. Management and maintenance requirements. Real estate investment often requires hands-on management. Investors may need to find tenants, handle maintenance, and deal with tenant issues, making real estate a more active investment. While property management companies can handle these tasks, they come with added costs that can impact profit margins. Stocks, however, require minimal management. Once you've made an investment, you can essentially leave it to grow occasionally adjusting your portfolio based on market trends. For investors who prefer a hands-off approach, stocks may be the preferable choice. 4. Tax benefits and deductions. Real estate offers numerous tax benefits, including deductions on mortgage interest, property taxes, insurance, and depreciation. Additionally, capital gains for real estate held for over a year can be subject to lower long-term capital gains tax rates. These deductions can offset the costs of owning and managing property, providing substantial tax savings. Stocks also offer tax benefits, but are generally less extensive than those in real estate. Long-term capital gains on stocks are taxed at a lower rate than short-term gains, and dividend income may qualify for favorable tax treatment depending on the holding period. Some retirement accounts, like IRAs and 400 and ONIC, allow investors to grow their stock investments tax-free or tax-deferred. 3. Inflation protection. Real estate serves as a natural hedge against inflation. As inflation rises, so do property values and rental income, helping investors maintain purchasing power. This inflationary resilience is one reason real estate is often a part of diversified portfolios. Stocks can also protect against inflation, particularly those in industries with pricing power, like utilities or consumer goods. Certain stocks, like commodities or real estate investment trusts, REITs, can perform well in inflationary environments. However, during periods of high inflation, stock market volatility can increase, impacting investors' peace of mind. 2. Liquidity and ease of access. Stocks are highly liquid, making it easy to buy and sell shares on the market within seconds. This liquidity allows investors to quickly access cash or make portfolio adjustments based on market conditions. Stocks are an excellent choice for those who may need to access their money more frequently. Real estate is less liquid due to the time and complexity involved in selling property. Real estate transactions can take weeks or months, and fees from real estate agents and closing costs can be high. However, investors looking for a long-term, relatively stable investment are often willing to trade liquidity for stability. 1. Long-term wealth building. Both stocks and real estate can serve as vehicles for long-term wealth building, depending on individual preferences, time horizons, and risk tolerance. Real estate stability and ability to generate rental income make it a solid option for those wanting a tangible asset with steady returns. It's ideal for individuals seeking to hold assets that generally appreciate over time, while providing a buffer against inflation. Stocks, however, have historically offered higher returns and are suitable for those who can tolerate short-term volatility for long-term growth. With consistent investing and reinvested dividends, stock portfolios can grow substantially, often outpacing real estate in terms of returns. Stocks also offer a level of diversification through the ability to invest in different industries, countries, and asset types, spreading risk across sectors. That's the lowdown on real estate versus stocks. If you're ready to make a choice or have experience with either, hit subscribe and share your investment journey in the comments. Thanks for watching, and I'll see you in the next video.